Question 1. Scenario-based scenario. Mrs. Thompson is a 75-year-old woman who recently suffered a stroke. She now requires assistance with two activities of daily living adults, including bathing and dressing. She also has some cognitive impairments, though she remains largely independent in decision-making. She purchased a long-term care insurance policy 5 years ago that included a 90-day elimination period and coverage for both home health care and nursing home care. Mrs. Thompson prefers to stay at home and receive home health care. Based on her condition and the policy she purchased, what is the most likely course of action? A. Mrs. Thompson will immediately receive benefits from her long-term care policy for home health care services. B. Mrs. Thompson is eligible for nursing home care benefits, but home health care benefits will not apply. C. Mrs. Thompson must first satisfy the 90-day elimination period before her home health care benefits start. D. Mrs. Thompson will need to demonstrate additional cognitive impairments to qualify for any benefits. Answer. C. Mrs. Thompson must first satisfy the 90-day elimination period before her home health care benefits start. Explanation. The elimination period is the waiting period that must be satisfied before long-term care insurance benefits begin. In this case, Mrs. Thompson's policy has a 90-day elimination period, meaning she will not receive benefits for the first 90 days after becoming eligible for coverage. Long-term care insurance policies typically cover home health care as well as nursing home care if the insured individual requires assistance with two or more adults, which Mrs. Thompson does. No additional cognitive impairments are required for eligibility in her case. This scenario illustrates the importance of understanding elimination periods and eligibility requirements in long-term care policies. Relevant laws, such as those governed by the NAIC Long-Term Care Model Act, often ensure policies clearly outline elimination periods to avoid confusion. Question 2. Which of the following factors is likely to have the greatest impact on a long-term care insurance policyholder's premiums at the time of purchase? A. The policyholder's age and health at the time of purchase. B. The types of care facilities available in the policyholder's geographic location. C. The current inflation rate. D. The number of family members who might provide informal caregiving. Answer. A. The policyholder's age and health at the time of purchase. Explanation. Age and health are critical factors in determining the cost of long-term care insurance premiums. Insurers assess these factors through medical underwriting to evaluate the risk and likelihood of the policyholder needing care. Younger, healthier individuals typically receive lower premiums because they are less likely to require immediate or near-term long-term care services. In contrast, older individuals or those with pre-existing health conditions may face significantly higher premiums. Geographic location, option B, while relevant for determining where care can be provided, does not directly influence premium cost as much as age and health. The current inflation rate, option C, may impact future benefit payouts if the policy includes inflation protection, but it does not play a significant role in the initial premium calculation. Family caregivers, option D, may help reduce the need for professional care, but they are not a determining factor for premiums. This is regulated by state guidelines and actuarial standards applied during policy underwriting. Question 3. What is the key difference between reimbursement and indemnity long-term care insurance policies? A reimbursement policy pays a fixed daily amount regardless of actual costs, while an indemnity policy pays based on the actual costs incurred by the insured. B. An indemnity policy pays a fixed daily amount regardless of actual costs, while a reimbursement policy pays based on the actual costs incurred by the insured. C. Both reimbursement and indemnity policies pay based on the actual costs incurred, but reimbursement policies are limited to nursing home care. D. Indemnity policies are only available through employer-sponsored plans, while reimbursement policies are available to individuals. Answer. B. An indemnity policy pays a fixed daily amount regardless of actual costs, while a reimbursement policy pays based on the actual costs incurred by the insured. Explanation. Reimbursement policies provide coverage by reimbursing the insured for the actual costs incurred for long-term care services up to the policy's maximum benefit. This means if a policyholder incurs lower costs than the daily or monthly benefit limit, they are only reimbursed for the actual amount spent. In contrast, indemnity policies pay a fixed daily or monthly amount regardless of the actual cost of care. For example, if the indemnity policy has a $200 daily benefit and the insured only incurs $150 in costs, the insured still receives $200. This difference is significant when evaluating policy options, as reimbursement policies are generally more cost-efficient if the actual cost of care is lower, while indemnity policies may provide additional funds to cover other expenses. These concepts are regulated under the NAIC Long-Term Care Insurance Model Act, which defines policy terms to ensure clarity for consumers. Question 4. Under the West Virginia Long-Term Care Insurance Regulations, which of the following best describes the conditions that would allow an insured individual to qualify for benefits related to cognitive impairments? A. The insured must be completely incapable of performing all adults. B. The insured must demonstrate significant cognitive impairment, such as Alzheimer's disease or dementia, that requires substantial supervision. C. The insured must have a medical doctor certify a total physical disability before qualifying for benefits. D. The insured must be over the age of 65 and diagnosed with a mental health condition. Answer. B. The insured must demonstrate significant cognitive impairment, such as Alzheimer's disease or dementia, that requires substantial supervision. Explanation. Under West Virginia long-term care insurance regulations, cognitive impairments like Alzheimer's disease or dementia are considered triggers for benefit eligibility if they result in the need for substantial supervision to protect the individual from threats to their health and safety. Cognitive impairments are evaluated based on the insured's ability to function independently and their need for constant supervision. Options A, C, and D are incorrect because long-term care benefits do not require total physical disability or specific age requirements beyond the conditions set out in the policy for cognitive impairments. Relevant guidelines from HIPAA provisions also outline cognitive impairments as a qualifying condition for benefits. Question 5. What is the primary purpose of the elimination waiting period in a long-term care insurance policy? A. It allows the policyholder time to decide whether they want to file a claim. B. It is the period during which benefits will be paid out after an insured has been certified as eligible for long-term care. C. It is the waiting time before the insured can begin receiving benefits after meeting eligibility requirements. D. It provides a period for the insurer to reassess the insured's medical condition before granting benefits. Answer. C. It is the waiting time before the insured can begin receiving benefits after meeting eligibility requirements. Explanation. The elimination waiting period is the time an insured must wait after becoming eligible for long-term care benefits, i.e., satisfying a DL or cognitive impairment requirements before the insurer begins paying benefits. This period acts as a deductible in time, often ranging from 30 to 180 days, depending on the policy. The policyholder is responsible for covering care costs during this waiting period. Options A and D are incorrect because the elimination period is not about decision-making or reassessment, but simply a delay in benefit payments. This feature is regulated under state insurance laws and is common across policies to manage costs. Question 6. Which of the following policy provisions is most likely to protect an individual's long-term care insurance policy from lapsing due to non-payment of premiums during a period of incapacity? A. Inflation protection. B. Waiver of premium. C. Shared care provisions. D. Non-forfeiture benefits. Answer. B. Waiver of premium. Explanation. The waiver of premium provision allows the insured to stop paying premiums once they are receiving long-term care benefits, as long as they are eligible under the policy terms. This ensures that the policyholder's insurance coverage continues without lapse due to non-payment while they are incapacitated or receiving care. Options A and C provide different types of benefits, such as inflation protection, adjusting benefits for inflation, and shared care, allowing couples to share benefits, but neither addresses premium payments. Option D, non-forfeiture benefits, provides a limited benefit if the policy lapses, but it doesn't prevent lapses from happening due to non-payment during care periods. Waiver of premium is a key feature under the NAIC Long-Term Care Insurance Model Act. Question 7. Scenario-based scenario. Mr. Anderson, age 65, has been diagnosed with moderate dementia and has difficulty managing his finances and medication. He purchased a long-term care insurance policy 10 years ago that includes an inflation protection rider and a 90-day elimination period. His policy also covers both home health care and nursing home care. His family prefers to hire an in-home caregiver to assist him. However, Mr. Anderson has not yet been approved for benefits. What is the most appropriate next step to secure long-term care insurance benefits for Mr. Anderson? A. Mr. Anderson should apply for benefits immediately, and once his cognitive impairment is verified, the elimination period will begin. B. Mr. Anderson should hire the caregiver immediately and file for reimbursement from his insurance company. C. Mr. Anderson must wait until he is fully dependent on others for all 8 DLS before applying for benefits. D. Mr. Anderson is ineligible for benefits unless he moves to a nursing home. Answer A. Mr. Anderson should apply for benefits immediately, and once his cognitive impairment is verified, the elimination period will begin. Explanation: the correct process is to apply for benefits immediately, as cognitive impairment, such as dementia, is a trigger for long-term care insurance eligibility, assuming the policy includes cognitive impairments in its terms. Once his impairment is verified, a 90-day elimination period will begin, during which time Mr. Anderson would need to pay out of pocket for care. Options B, C, and D are incorrect because the policy covers home health care, not just nursing homes, and eligibility does not require full ADL dependency. The elimination period applies regardless of the care setting. West Virginia's long-term care insurance regulations follow an AIC guidelines that include cognitive impairment as a valid benefit trigger. Question 8. Which of the following best describes the role of activities of daily living adults in determining eligibility for long-term care insurance benefits? A. DLS are used to calculate the policy's maximum daily benefit. B. A DLS are used as a qualifying metric to determine when the insured is eligible for benefits. C. A DLS are a factor in determining the premium at the time of policy purchase. D. A DLS are only relevant for cognitive impairment coverage. Answer: B. A DLS are used as a qualifying metric to determine when the insured is eligible for benefits. Explanation: adults, such as bathing, dressing, eating, and toileting, are key criteria used by long-term care insurance policies to determine when an insured individual qualifies for benefits. Most policies require the insured to be unable to perform a certain number of a DLS, usually 2 or more, to trigger benefit eligibility. Option A is incorrect because a DLS do not determine the maximum benefit amount, and option C is incorrect because premiums are determined by other factors like age and health at the time of purchase, not adults. A DLS are relevant to all forms of care, not just cognitive impairment coverage, making option D incorrect. Question 9. What is the primary advantage of purchasing a West Virginia long-term care partnership policy compared to a traditional long-term care insurance policy? A. Partnership policies offer a higher benefit limit than traditional policies. B. Partnership policies allow the insured to qualify for Medicaid without meeting the usual spend-down requirements for assets. C. Partnership policies guarantee premium stability, while traditional policies do not. D. Partnership policies provide benefits for cognitive impairments only, while traditional policies do not. Answer: B. Partnership policies allow the insured to qualify for Medicaid without meeting the usual spend-down requirements for assets. Explanation: a key feature of West Virginia long-term care partnership policies is the asset protection they provide. If the policyholder exhausts their benefits and needs to apply for Medicaid, the amount paid out by the partnership policy is disregarded in Medicaid's asset eligibility determination. This allows individuals to retain a greater portion of their assets while still qualifying for Medicaid assistance. Option A is incorrect because benefit limits depend on the policy, not whether it's a partnership policy. Option C is incorrect because premium stability is not guaranteed under either type of policy. Option D is incorrect because traditional policies also cover cognitive impairments. Partnership policies are a result of the Deficit Reduction Act of 2005 and state reciprocity agreements. Question 10. Which of the following would disqualify an applicant from purchasing long-term care insurance due to underwriting factors? A family history of Alzheimer's disease. B. A history of smoking. C. Recent hospitalization for a stroke. D. Being over the age of 65. Answer: C. Recent hospitalization for a stroke. Explanation: underwriting for long-term care insurance takes into account an individual's medical history, including recent serious health events such as strokes. A recent stroke may disqualify an applicant from obtaining long-term care insurance or result in significantly higher premiums due to the increased likelihood of needing care. Options A, B, and D are incorrect because while family history, smoking, and age may influence premiums, they do not automatically disqualify someone from obtaining coverage. West Virginia's long-term care underwriting practices, like those across many states, are guided by medical underwriting standards that assess an applicant's current health conditions and recent medical history. Question 11. What is the minimum inflation protection percentage that must be offered with a long-term care insurance policy in West Virginia for a policyholder under age 75? A. 2%, B. 3%, C. 5%, D. 8%. Answer: C. 5%. Explanation: West Virginia's long-term care insurance regulations mandate that insurers offer inflation protection of at least 5% annually to policyholders under the age of 75. This helps ensure that the value of the benefits keeps pace with rising healthcare costs. Option A is incorrect because 2% is below the state requirement. Options B and D are also incorrect because while inflation protection may vary, the minimum required offering must be 5%. Question 12. Which of the following is not a standard exclusion in West Virginia long-term care insurance policies? A. Care provided by family members. B. Alcoholism or drug addiction. C. Pre-existing conditions for up to 12 months. D. Care required due to a felony conviction. Answer A. Care provided by family members. Explanation: West Virginia long-term care insurance policies typically exclude coverage for care provided by family members unless the policy specifically states otherwise. Options B, C, and D represent standard exclusions in long-term care policies, including exclusions for self-inflicted injuries or care arising from a felony conviction. Exclusions such as pre-existing conditions can be limited to a maximum of 12 months under state regulations. Question 13. In West Virginia, if an individual purchases a long-term care policy at age 60 with a 180-day elimination period, when will they begin to receive benefits if they become eligible on June 1? A. Immediately on June 1. B. After 60 days on July 31. C. After 90 days on August 29. D. After 180 days on November 28. Answer: D. After 180 days on November 28. Explanation: an elimination period in a long-term care policy acts as a waiting period before benefits begin. In this scenario, with a 180-day elimination period, the policyholder would not receive benefits until November 28, 180 days after becoming eligible on June 1. This waiting period is sometimes used to reduce premiums. The other options are incorrect because they do not account for the full elimination period. Question 14. Which of the following correctly describes the guaranteed renewability provision found in most long-term care insurance policies? A. The insurer can cancel the policy at any time as long as 30 days notice is provided. B. The insurer can only increase premiums if the insured's health worsens. C. The insurer must renew the policy each year as long as premiums are paid. D. The insured can renew the policy only until they turn 75. Answer: C. The insurer must renew the policy each year as long as premiums are paid. Explanation: a guaranteed renewable provision means that the insurer cannot cancel the policy as long as the premiums are paid on time. This protects the insured from losing coverage due to health changes. Option A is incorrect because the policy cannot be cancelled at the insurer's discretion. Option B is incorrect because premium increases cannot be based on an individual's health. Option D is incorrect because there is no age limit on renewability if the premiums continue to be paid. Question 15. Which provision ensures that if an individual lets their long-term care policy lapse due to cognitive impairment or loss of functional capacity, they can reinstate the policy under certain conditions? A. Grace period. B. Contingent benefit upon lapse. C. Non-forfeiture benefit. D. Reinstatement provision. Answer: D. Reinstatement provision. Explanation: the reinstatement provision allows a policyholder to reinstate their long-term care insurance if the policy lapses due to cognitive impairment or loss of functional capacity, provided certain conditions are met, such as submitting a request within a specified time frame. This provision ensures coverage continues for vulnerable individuals. Option A refers to a grace period, which applies to missed premium payments. Option B applies to benefits upon policy lapse, and Option C provides reduced benefits if a policy lapses, but neither addresses cognitive impairment. Question 16. Under West Virginia regulations, what is the maximum period a long-term care policy can impose for pre-existing condition exclusions? A. 6 months. B. 12 months. C. 24 months. D. 36 months. Answer: B. 12 months. Explanation: West Virginia limits the exclusion period for pre-existing conditions in long-term care insurance policies to a maximum of 12 months. This means that after this period, the policy must cover any pre-existing conditions the insured had when they purchased the policy. Options A, C, and D are incorrect because 12 months is the maximum exclusionary period allowed under state regulations. Question 17. Which of the following best defines a non-forfeiture benefits eka long-term care insurance policy? A. Benefits that increase if premiums are paid consistently over time. B. Benefits that remain available if the policy lapses due to non-payment. C. Benefits that reduce the elimination period if care is needed earlier than expected. D. Benefits that transfer to a spouse if the insured dies. Answer: B. Benefits that remain available if the policy lapses due to non-payment. Explanation: non-forfeiture benefits ensure that the policyholder will receive some level of benefits even if the policy lapses due to non-payment. These benefits are often reduced in comparison to the full policy but provide a safeguard for those who can no longer afford to pay premiums. Options A, C, and D are incorrect because non-forfeiture benefits do not involve increasing benefits over time, reducing the elimination period, or transferring benefits to a spouse. Question 18. How often must West Virginia long-term care insurance policies provide the option to lower coverage or premiums if the policyholder cannot afford the current premium levels? A. Annually. B. Every 2 years. C. Every 5 years. D. There is no requirement to offer this option. Answer A. Annually. Explanation: West Virginia law requires that long-term care insurance policies provide policyholders with the option to reduce their coverage or premiums at least once a year. This allows individuals to maintain coverage even if they can no longer afford the original premium payments. Option D is incorrect, as there is a legal requirement to offer this option. Question 19. Which type of care is most commonly covered by long-term care insurance policies in West Virginia? A. Acute hospital care. B. Rehabilitation services only. C. Custodial care and assistance with adults. D. Surgical procedures. Answer: C. Custodial care and assistance with adults. Explanation: long-term care insurance is designed to cover custodial care and assistance with activities of daily living adults, such as bathing, dressing, and eating. This type of care is often provided in a home or nursing facility. Options A, B, and D are incorrect because long-term care policies do not typically cover acute hospital care, surgical procedures, or rehabilitation services alone, although some policies may offer limited coverage for rehabilitation. Question 20. What is the purpose of the look-back period in the context of Medicaid eligibility following the exhaustion of a West Virginia long-term care partnership policy? A. To determine whether the individual had other health insurance before applying for Medicaid. B. To review the individual's medical history for pre-existing conditions. C. To examine financial transactions and asset transfers made within the last 5 years. D. To ensure the individual meets age and health requirements for Medicaid. Answer: C. To examine financial transactions and asset transfers made within the last 5 years. Explanation: the look-back period refers to the 5-year window during which Medicaid examines the individual's financial transactions and asset transfers to determine eligibility. If assets were transferred during this period, it may affect Medicaid eligibility. This process helps prevent individuals from transferring assets to qualify for Medicaid. Option A is incorrect because it is unrelated to prior health insurance. Option B is incorrect because Medicaid does not review for pre-existing conditions. Option D is incorrect because the look-back period focuses on finances, not age or health requirements. Question 21. Under West Virginia long-term care insurance regulations, what is the minimum grace period required for late premium payments before a policy can be terminated? A. 10 days. B. 21 days. C. 31 days. D. 45 days. Answer: C. 31 days. Explanation: West Virginia requires a minimum 31-day grace period for long-term care insurance policies. This means the insurer cannot terminate the policy for non-payment of premiums until after this period has passed. Options A, B, and D are incorrect because they do not meet the minimum 31-day requirement under state law. Question 22. In West Virginia, what is the main purpose of the long-term care partnership program? A. To provide short-term coverage for acute medical conditions. B. To allow individuals to protect some assets while qualifying for Medicaid. C. To cover hospital expenses for seniors over 65. D. To reduce long-term care premiums for low-income individuals. Answer: B. To allow individuals to protect some assets while qualifying for Medicaid. Explanation. The Long-Term Care Partnership Program allows individuals to protect some of their assets if they use up their long-term care insurance benefits and then apply for Medicaid. This incentivizes people to purchase long-term care insurance without the fear of losing all their assets. Option A is incorrect because the program is not for short-term or acute medical care. Option C is incorrect because it does not focus on hospital expenses. Option D is also incorrect because the program's primary purpose is not premium reduction but asset protection. Question 23. Which of the following must be included in all West Virginia long-term care insurance policies to protect consumers from unintentional policy lapse? A. A lifetime premium freeze. B. An automatic inflation protection rider. C. The right to designate a secondary addressee to receive lapse notices. D. An immediate refund if the policyholder cancels. Answer. C. The right to designate a secondary addressee to receive lapse notices. Explanation. West Virginia requires long-term care insurance policies to include a provision allowing policyholders to designate a secondary addressee who will receive notification if the policy is in danger of lapsing due to non-payment. This protects policyholders from accidentally losing coverage, especially if they are unable to manage their own affairs. Options A and B are incorrect because these are not required protections. Option D is incorrect as immediate refunds are not mandated for policy cancellations. Question 24. In West Virginia, how long must an insurance company retain the records of all complaints received regarding long-term care insurance? A. 1 year. B. 3 years. C. 5 years. D. 10 years. Answer. C. 5 years. Explanation. West Virginia law requires that insurers retain all complaint records related to long-term care insurance policies for at least 5 years. This allows for regulatory oversight and ensures that consumer complaints are addressed properly. Options A, B, and D are incorrect because they do not match the required retention period. Question 25. Which of the following is not a requirement for long-term care policies sold in West Virginia under the Long-Term Care Partnership Program? A. The policy must be guaranteed renewable. B. The policy must provide inflation protection. C. The policyholder must be over age 70 to qualify. D. The policy must comply with federal regulations. Answer. C. The policyholder must be over age 70 to qualify. Explanation. There is no age requirement of being over 70 to qualify for the Long-Term Care Partnership Program. However, the policy must be guaranteed renewable, provide inflation protection, especially for those under 75, and comply with federal regulations. Option C is incorrect because the program is available to individuals under the age of 70 as well. Question 26. What happens if a West Virginia resident uses all of their long-term care insurance benefits under a partnership policy and still requires care? A. They will automatically qualify for Medicaid without regard to their assets. B. They will have to reapply for a new long-term care policy. C. They can keep a portion of their assets and still qualify for Medicaid. D. They will be disqualified from Medicaid because of prior insurance use. Answer. C. They can keep a portion of their assets and still qualify for Medicaid. Explanation. Under the Long-Term Care Partnership Program, individuals who exhaust their long-term care insurance benefits can qualify for Medicaid while retaining an amount of assets equal to the value of the benefits paid by the insurance. This helps protect their assets from being spent down to qualify for Medicaid. Option A is incorrect because Medicaid has asset limits. Option B is incorrect because they would not need to reapply for insurance. Option D is incorrect because having prior insurance does not disqualify them from Medicaid. Question 27. West Virginia long-term care insurance policies are required to offer which option for individuals who can no longer afford their premiums? A. A loan against the policy's benefits. B. The option to reduce coverage and premiums. C. A complete refund of all premiums paid. D. Automatic Medicaid enrollment. Answer. B. The option to reduce coverage and premiums. Explanation. West Virginia regulations mandate that insurers offer policyholders the option to reduce their coverage and premiums if they can no longer afford the existing premiums. This ensures that individuals can maintain some level of long-term care insurance rather than losing all coverage. Option A is incorrect because long-term care policies typically do not offer loans. Option C is incorrect as refunds are not required. Option D is incorrect because there is no automatic Medicaid enrollment associated with long-term care insurance. Question 20. which of the following is not considered an activity of daily living under West Virginia long-term care insurance regulations? A. Bathing. B. Dressing. C. Cooking. D. Eating. Answer C. Cooking. Explanation. Activities of daily living adults under long-term care insurance typically include basic self-care tasks such as bathing, dressing, eating, toileting, transferring, and continence. Cooking is not considered an ADL. Option C is correct, as cooking is more aligned with instrumental activities of daily living adults, which are not typically covered by long-term care insurance. Options A, B, and D are incorrect because they are all considered adults. Question 29. What is the typical penalty for transferring assets during the Medicaid look-back period in West Virginia? A. A denial of Medicaid benefits for 3 months. B. A denial of Medicaid benefits for 6 months. C. A period of ineligibility based on the value of the transferred assets. D. No penalty if the transfer occurred within 5 years of applying for Medicaid. Answer C. A period of ineligibility based on the value of the transferred assets. Explanation: if an individual transfers assets during Medicaid's 5-year look-back period, they may face a penalty period of ineligibility. The length of this penalty is based on the value of the assets transferred and the average cost of long-term care in the state. Options A and B are incorrect because the penalty is not a fixed time period. Option D is incorrect because the look-back period applies to transfers within 5 years. Question 30. Which of the following factors can result in a long-term care insurance premium increase in West Virginia? A. The insured's age. B. A statewide rate increase approved by the insurance commissioner. C. A claim filed by the policyholder. D. A change in the insured's health condition. Answer B. A statewide rate increase approved by the insurance commissioner. Explanation: long-term care insurance premiums can only be increased in West Virginia if a statewide rate increase is approved by the insurance commissioner. Insurers cannot raise premiums based on an individual's age, health condition, or claims history. Options A, C, and D are incorrect because they do not justify a premium increase under West Virginia law.